Friends, thank you for being here today. As we stand on the precipice of a significant economic shift, looking toward the horizon of 2026, we are forced to confront uncomfortable truths about the financial systems we have relied upon for decades. It is a time for serious reflection, not panic, and a time to question the conventional wisdom that has guided portfolio construction for the last 40 years. What if I told you that the very assets you believe are keeping you safe might actually be the things that leave you most vulnerable in the coming years? Have you ever truly asked yourself whether your definition of financial sufficiency is based on the stability of the past, or is it calibrated for the volatility of the future? These questions are not merely rhetorical, they are the foundation of survival in a changing monetary order. Most people operate under the assumption that owning some gold or silver automatically means they are protected, that just having exposure puts them on the safe side of what is coming. But history shows that this is not how monetary transitions work. In every major financial shift, from the inflationary spirals of the 1970s to the currency crises of emerging markets, the people who thought they were prepared were often the ones who were most underprepared. This was not because they owned the wrong assets, but because they owned too little, owned them incorrectly, or fundamentally misunderstood what those assets were actually supposed to do when the system came under real stress. As we move toward 2026, that distinction is becoming critical because the environment we are entering is not a normal economic slowdown. It is a structural transition involving debt, currencies, liquidity, and trust. In that kind of environment, vague exposure is not the same thing as real protection. The reason this conversation matters now, not in hindsight, is because positioning for safety is something that must be done before stress becomes obvious, not after. By the time the majority of people feel unsafe, the opportunity to position properly is already gone. I want to pause here for a moment and hear from you. Do you see these signs of structural stress in your own local economy? Please leave a comment below, sharing your thoughts on whether 2026 feels like a turning point to you, or if you think the current system has more runway than we think. This is why the central question we must answer is not simply whether gold and silver matter in 2026, but specifically, how much is actually enough to make a difference? To understand the urgency of this allocation and why 2026 represents a structural transition rather than a mere recession, we must first diagnose the economic patient. We are not facing a typical business cycle recession where GDP slows, unemployment ticks up, and the central bank cuts rates to stimulate growth. We are facing a structural transition. The core issue driving us toward 2026 is debt saturation combined with immense political pressure on monetary policy. Governments across the developed world are carrying debt loads that are mathematically impossible to service at positive real interest rates without imposing austerity measures that are politically suicidal. Therefore, the only viable path forward for the state is either sustained inflation or financial repression, a scenario where interest rates are kept artificially below the rate of inflation to burn away the real value of the debt. Central banks are trapped in a dilemma of their own making. They are caught between protecting the purchasing power of their currencies and protecting the solvency of asset markets and sovereign debt. History suggests that when forced to choose, central banks will almost invariably protect the markets and the government's ability to borrow. The cost of this choice is the currency itself. The structural reality exposes the vague exposure fallacy that traps so many investors. Many believe that having a few gold coins in a drawer or a small position in a mining ETF constitutes a hedge. It does not. Vague exposure fails during structural stress because it does not scale to meet the magnitude of the problem. If your currency loses 30% of its purchasing power over a 3-year period, a 2% allocation to gold will not save your standard of living. The preparation gap here is massive. Most people are underprepared, not because they lack the right assets entirely, but because they own too little to matter. Furthermore, the timing of this insurance is paramount. Financial insurance must be purchased when the skies are clear. By the time the storm is visible on the horizon, by the time inflation creates headlines or bond market seize up, the cost of protection rises exponentially and physical availability shrinks. The premium you pay for safety in 2026 will be vastly higher than the premium you pay today. Positioning must occur before the stress becomes obvious. Before we can determine how much, we must clearly define the roles these metals play and why they are essential. Gold and silver are not magic assets. They do not prevent volatility, and they do not generate cash flow in the traditional sense. What they do is protect purchasing power across monetary disruptions, policy mistakes, and confidence shocks. They act as monetary insurance. Let's start by considering gold, which acts as the ultimate anchor of credibility. Its primary function is to serve as a hedge against currency debasement and a store of value during periods where trust in institutions evaporates. We are already seeing the smartest money in the room positioning for this. Central banks are accumulating gold at the fastest rate in decades. They are not doing this to make a profit in fiat terms. They are doing this to reduce counterparty risk. When the institutions that issue the currency choose to hold an asset that cannot be printed, it is a signal that individual investors should not ignore. They are diversifying away from political risk, specifically the weaponization of the dollar and the fragility of the euro. Despite the persistent myth that gold is a pet rock that offers no yield, the performance reality tells a different story. In recent metrics leading up to 2025 and beyond, gold has outperformed major indices like the S&P 500 and even high-growth assets like Bitcoin during specific volatility windows. It is doing exactly what it is designed to do, preserving capital when the real yield on paper assets turns negative. While gold provides stability, silver acts as a volatile hybrid, playing a different, more aggressive role. It is a hybrid asset, straddling the line between a monetary metal and an essential industrial commodity. It is critical for the green energy transition, used in solar panels, electric vehicles, electronics, and increasingly in defense technologies. This dual nature means silver is sensitive to both monetary policy and industrial demand cycles. As we approach 2026, silver appears to be in a catch-up phase. Historically, silver lags gold at the beginning of a bull market, but accelerates rapidly towards the end, often in a reverse bubble dynamic. While gold has made new nominal highs in almost every global currency, silver is still chasing its inflation-adjusted highs from 1980 and 2011. This disparity suggests significant upside potential. If gold is the shield, silver is the sword, offering the potential for leverage and growth, but coming with the cost of extreme volatility. Price targets in the range of $73 to $100 per ounce are not merely speculative dreaming. They are based on historical ratios and the necessity of price to incentivize new mining supply in a deficit market. Beyond the specific mechanics of the metals, the most compelling argument lies in the reality of purchasing power. When we price assets in gold rather than dollars, we see a deflationary reality that benefits the holder. For instance, since 2007, the price of a median U.S. home has actually dropped approximately 53% when priced in gold. Similarly, the cost of technology, such as an iPhone, has plummeted by roughly 75% in gold terms and 68% in silver terms over the same period. This proves that metals do not just keep up with inflation, they often outpace it, effectively increasing your standard of living relative to those holding fiat currency. In a world of shrinking abundance, gold and silver effectively make life cheaper. With that context established, we arrive at the crux of the matter, the allocation frameworks to determine how much is enough for 2026. There is no single universal number, but there are frameworks based on historical success during monetary resets. For investors looking at their total net worth, we start with a portfolio percentage approach. The meaningful range for precious metals allocation historically falls between 10% and 25%. If you fall below 10%, your allocation is psychologically comforting. It allows you to say you own gold, but it is mathematically irrelevant during a true currency crisis. If inflation runs at 15% and your 5% gold position doubles, the impact on your total portfolio is negligible compared to the loss of purchasing power in your bonds and cash. Conversely, if you go above 25%, while higher allocations can offer massive upside, they introduce significant liquidity risks and volatility concerns. Unless you have extremely low living expenses or a very high risk tolerance, going all in can force you to sell metals at the wrong time to cover daily bills. Within this percentage, the balance between gold and silver matters. A conservative allocator, someone focused primarily on wealth preservation, might opt for a mix of roughly 2/3 gold and 1/3 silver. This provides the stability of gold with a kicker of growth from silver. An aggressive allocator, perhaps younger or with a smaller capital base looking to build wealth, might tilt toward a 50-50 split, accepting the wilder swings of silver for the chance of greater appreciation. However, percentages can be abstract. So for the average person just trying to ensure they are not wiped out, we can look to the absolute minimum baseline strategy, often called the 5 and 200 rule. This is a specific, tangible target: 5 ounces of gold and 200 ounces of silver. Why these numbers? When originally calculated around 2021, this stack was estimated to cover approximately 3 months of average household living expenses. It was designed as a survival bridge. However, due to the appreciation of metal since then, this specific stack now covers approximately 6 months of expenses based on current data. This allocation acts as your financial bunker. It is not an investment for capital gains. It is the emergency fund layer that sits outside the banking system. It ensures that if the banks close for a week, or if a currency reform devalues cash overnight, you have half a year of purchasing power physically in your possession. This is the baseline. Until you reach this level, you are essentially naked in a storm. Of course, simply owning the metal is only step one. How you hold it and manage it determines your success as we implement this strategy. We we must first address the critical issues of liquidity and sequencing. One of the greatest dangers in a precious metals strategy is the liquidity trap. Physical metals are less liquid than cash or digital equities. You cannot swipe a gold coin at the grocery store today. Therefore, metals must sit on top of a cash emergency fund, not replace it. You must avoid the scenario where you're forced to sell your insurance, gold, during a short-term dip just to pay for a car repair or a medical bill. This forced selling destroys wealth. You must also understand the sequence of events. In a crisis, gold often leads during the initial confidence shock. It is the flight to safety. Silver tends to lag, then accelerate later as liquidity expands and inflation becomes undeniable to the public. Finally, volatility clusters. We should expect long periods of boring price action followed by violent repricing. Patience is the price you pay for the reward. This brings us to the form of ownership, specifically the distinction between physical metal and paper instruments. In a structural transition involving trust, counterparty risk is the enemy. This makes physical ownership, coins and bars in your possession or in a non-bank vault, essential. Physical metal cannot be defaulted on. It has no liability attached to it. Paper gold, ETFs, futures, has a place for trading or for short-term liquidity management, but it relies on the stability of the financial system. If your goal is to hedge against the failure of that system, using a product of that system is a contradiction. A layered approach is prudent. Prioritize physical ownership for your core insurance allocation, the 10-25%, and perhaps use reliable funds for speculative plays beyond that. Beyond the mechanics of your personal portfolio, we must also broaden our lens to the geopolitical fires that are acting as accelerants to this entire process. The road to 2026 is paved with the increasing fragmentation of the global order, a reality that profoundly changes the safe haven calculation. We are witnessing a divergence in the global trade system where the neutrality of an asset is becoming its most valuable characteristic. The weaponization of the dollar through sanctions has taught every central bank and sovereign nation a critical lesson. Your reserves are not truly yours if they are held in a currency controlled by a political adversary. This realization is driving a structural bid for gold that is entirely independent of retail demand or standard inflation metrics. When we talk about enough gold and silver, we must realize we are competing for finite supply against nation-states that are actively trying to de-risk their entire economies. This geopolitical floor under the price of metals suggests that the buy-the-dip opportunities of the past may be shallower and shorter-lived as we approach 2026. The volatility will remain, but the trajectory is being reinforced by forces far larger than the COMEX futures market. However, there is a distinct danger in this analysis that we must address, and that is falling in love with the lifeboat. Gold and silver are the bridge. They are not the destination. A critical part of your strategy for 2026 involves understanding the end game or the exit strategy. The purpose of accumulating these metals is not to hoard them like a dragon until the end of time. It is to preserve your purchasing power so that you can deploy it when other productive assets are distressed. This is the concept of the wealth transfer. Historically, there comes a moment in every major monetary reset where the ratio between hard money, gold, and paper assets, stocks, real estate, becomes incredibly favorable for the holder of gold. For example, in 1980, the Dow to gold ratio hit 1.1, meaning 1 ounce of gold could buy the Dow Jones Industrial Average. Today, that ratio is stretched. As we move through this transition, we are looking for that ratio to compress, perhaps to 5:1 or even lower. That is the signal. That is the moment where enough gold transforms into generational wealth. The strategy is to trade your static insurance for cash-flowing production, undervalued businesses, land, or equities, precisely when the rest of the world is panic selling them. This requires a psychological resilience that is often harder than the financial accumulation itself. The hardest part of this strategy is not buying the metal. It is the boredom phase where the metal does nothing while other speculative assets soar, followed by the terror phase where everything is volatile. You must have the conviction to sit still when you look wrong, so you can act decisively when you are right. If you do not have a defined exit strategy or a ratio in mind, you risk riding the elevator up and riding it all the way back down. Enough for 2026 is not just about survival. It is about positioning yourself to be a liquidity provider when the world is illiquid. It is about converting a defensive position into an offensive legacy. Finally, in terms of strategy, we must discuss the discipline of rebalancing. The goal is not to maximize returns to the last penny, but to minimize regret. As we approach 2026, if metals perform as expected, they will become a larger percentage of your portfolio. If your 10% allocation grows to become 40% of your net worth, you must have the discipline to rebalance. Trimming your position to lock in purchasing power gains, perhaps to buy undervalued real estate or productive businesses, is how you solidify wealth. Conversely, during the inevitable smashdowns in price, having the courage to add modestly to your position is what separates the professionals from the tourists. So, what is the answer? How much gold and silver is actually enough for 2026? Enough is not a number that someone else can give you. It is the amount that allows you to sleep at night. It is the amount that provides you with financial flexibility without constant second-guessing. Mathematically, it is the amount that would meaningfully offset a severe decline in the purchasing power of your paper assets. If you are looking for a concrete goal, strive for the 5 and 200 baseline to secure your 6-month survival bridge. If you are looking for wealth preservation, aim for that 10-25% of net worth, balancing the stability of gold with the optionality of silver. If you have found value in this deep dive analysis and want to stay ahead of these critical economic shifts, please take a moment to hit the like button and subscribe to the channel. Your support helps us reach more people who need to hear this message before the window of opportunity closes. Success in the coming transition belongs to those who position conservatively and intentionally. It belongs to those who act before the stress creates a stampede. The window to think clearly is always before urgency takes over. That window is still open, but it does not stay open forever. The question is not if the system will change. The math dictates that it must. The question is only whether your portfolio is resilient enough to survive the change. Thank you.